Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's just dive right in. We're looking at super microcomputer, SMCI. As of today, December 18th, 2025, the stock is trading around $29.84, and that's after another drop. What was it? About 5.75% in the last session. I mean, this pressure has been just relentless, especially since that 10-for-1 forward split back in October of 24. It's just been trading miles below the post-split price of, 41.60. It's become a total battleground.
A battleground is right.
And so the central question, the thing everyone's trying to figure out is this price decline a permanent derating of the business? Is it just a commoditized hardware box mover now? Or are we looking at a massive, almost irrational overselling that's just driven by some temporary technicals and, I admit, some pretty severe regulatory headwinds? My position is frankly pretty clear. The fundamentals are screaming that this is a profound, mispriced, deep value opportunity.
Okay, I hear the bullish case, I really do. But I come at this from a completely different angle. While the price is low, I think the market has correctly applied a really severe governance discount here. This isn't deep value. To me, it is the perfect definition of a value trap. When you look past that very alluring revenue number, the fundamental economics of this business are, they're broken. The gross margins have collapsed, the internal control failures are chronic, and those issues make that huge top-line revenue number, highly suspect.
But we have to start with the sheer size of the valuation paradox. I mean, the disconnect is just too wide to be brushed off with vague governance fears. Let's do the math. Management has reiterated multiple times their guidance for $33 billion in revenue for fiscal year 2026. Now, you take the current market cap, which is sitting somewhere between $17 and $18 billion. That puts the stock at a price-to-sales ratio of already 0.5.
Right.
Think about what that means. A half-time sales multiple. That's what you give to a genuinely distressed hardware distributor, a company that might not make it. It's not the multiple for a key supplier in the AI server and liquid cooling space.
I get the shock value of that 0.5 PS number, I do, but I'm sorry, I just don't think revenue is the right metric when the economics of earning that revenue are falling apart so quickly. We have to focus on the margin erosion. That's the real story here. The single most important data point is the compression of gross margins, down to a mere 9.3% in the last quarter. That is a stark 380 basis point drop from 13.1% last year. You just can't claim deep value when your core profit engine has seized up like that.
But that's my point. If we just get moderate stabilization, let's just say the market decides SMCI is an average player and gives it a 1x sales multiple. That's still incredibly conservative for this kind of growth, and the share price doubles instantly. We're talking about a potential 100% upside just to get out of the distressed bucket. And on top of that, you have this massive technical pressure cooker building. The directional short interest is still sky high at 17.14% of the float with almost 5 days to cover. The shorts are crowded. One positive catalyst, like a clean Q1 filing, could trigger an absolutely devastating short squeeze.
That technical leverage is compelling, I'll give you that, but it all depends on the health of the business, and the margins show profound weakness. That 9.3% isn't just a blip, it's a symptom of two huge factors. First, competitive saturation. The big guys, Dell, HPE, they're now all in on AI servers, which is crushing SMCI's pricing power. And second, the product mix is getting really expensive. This shift to complex, liquid-cooled data centers, it carries way higher manufacturing and warranty costs. The market is just saying, we are not paying a growth multiple for single-digit gross margins. And that's before we even talk about the elephant in the room, the chronic filing delays that make the stock basically uninvestable.
I accept that 9.3% is a huge concern, and I see the competition. But to call that $33 billion in revenue low quality, I just think that misses the point. The revenue itself proves they're still a major player in this massive market. Now, when we talk about operational quality, you're going to point to the cash conversion cycle, the CCC.
Exactly. The CCC, the time it takes for them to turn inventory into actual cash. It's exploded from 96 days to 123 days. I mean, that 27-day jump is critical. It means they are sitting on incredibly expensive GPU-heavy inventory for way longer. That's not a scheduling problem. That signals real operational friction.
But doesn't that friction need context? Is it a systemic failure, or is it just the cost of scaling this quickly in a hyper-fast market? They're trying to keep up with absolutely unprecedented demand for these advanced components. Acquiring and deploying these systems take time, it takes capital. So while a rising CCC is a risk, I see it as a scaling risk, not a solvency risk.
I have to challenge that. A rising CCC in an environment of falling margins is a massive red flag for liquidity risk. If you're piling up expensive inventory faster than you can get cash for it, you might need to raise capital. And at this stock price, any capital raise would be hugely dilutive and would just undermine your entire deep value case. But, even putting that aside, the biggest issue is trust, which brings us back to governance. You say the regulatory risks are transient, and okay, they did score a big win back in February of 2025.
That's right. And that's a crucial, often overlooked point. EY resigned in October 24 with some very harsh words, but management still hit that NASDAQ deadline. They filed the delayed 10K with no restatements of historical financials. They dodged the delisting bullet and basically proved the issue was messy compliance, not outright fraud.
They survived that battle, yes, but they lost the war for institutional trust. The fact that we are delinquent again, right now in December 2025, citing the same internal control issues, it completely negates that previous success. For big institutions, this inability to file on time is now a chronic condition. I really can't stress this enough. It makes reliable financial modeling impossible, it jacks up the risk premium, and it renders the stock uninvestable for a huge amount of money, no matter what the PS ratio is. The price we see today is the cost of that opacity.
I can see that. The institutional money is paralyzed by the opacity, and it's created an air pocket in the stock. But if the fundamentals are sort of frozen by this regulatory hurdle, then the price has to be driven entirely by technicals. And this is where the potential for that short squeeze really lives. You hear a lot of talk about off-exchange trading, right? Dark pools, and the volume is huge. We see days where dark pool volume is, over 600,000 shares versus maybe 500,000 on the lit exchanges.
Hold on. Let's flip that perspective. The dominance of dark pools is what facilitates institutional distribution under the radar. The funds that want out, because of the margins and governance we just talked about, they use these unlit venues to dump huge blocks of stock without crashing the public order book. So that activity is actually masking the true intensity of the selling pressure. It's a slow, calculated institutional exit.
That's one interpretation for sure, and it explains the slow grind down. But it misses the other half of the equation, retail order flow. A massive chunk of that off-exchange volume is just market makers internalizing retail orders from, the ridden Wall Street bets crowd. A retail trader hits buy, the market maker absorbs the order, shorts the stock to them, and then hedges in the dark pool. It's why all that retail buying often doesn't move the needle on the lit exchange.
And let's be real about that retail sentiment. It's completely shifted. It went from SMCI's AI beta to, well, now it's just a forum for cynicism and loss porn. That is a textbook sign of retail capitulation. The weak hands are finally getting washed out.
I agree. The nihilism suggests we're in a late stage of the bear trend. But it also confirms that a massive structural short position has been built, both by directional shorts and by that market maker hedging. So you have the official 17% short interest, but the real pressure is in that technical setup. The moment a real fundamental catalyst hits, that retail crowd, despite being fatalistic now, will pile back in and provide the fuel for a squeeze. The institutional selling you mentioned is finite. This technical short position is levered and incredibly fragile.
I'm just not convinced it's a coiled spring. The high off-exchange short volume, 44 to 60%, that primarily reflects market makers just manufacturing liquidity by shorting into the bid. That pattern is structurally bearish. It confirms that natural buy demand isn't there to absorb the selling pressure. The price is only moving because of engineered volatility, and right now that's being engineered to the downside.
Okay, before we wrap up, we have to address one thing, just for clarity's sake. Because the price is so low, a lot of people think there was a reverse stock split. We need to be crystal clear. Supermicro has never done a reverse split. The current price is purely the result of the 10-for-1 forward split last year, followed by this relentless organic selling.
That's an excellent point, and it actually reinforces my value trap thesis. Look at their peers, NVIDIA, Broadcom. They did similar forward splits in 2024, and their stocks went up from the increased accessibility. SMCI's subsequent collapse just highlights its unique idiosyncratic risks, the margins, the governance, that its competitors just don't have. The split wasn't the problem, the broken company was.
I think this discussion really gets to the core of the paradox. I stand by my belief that the market is applying a just wildly inappropriate discount to a business that is guiding for $33 billion in revenue. The core problem here is regulatory timing, not a structural collapse. If, and it's a big if, that Q1 10Q gets filed cleanly, the current half-time sales multiple offers, frankly, generational upside. They've proven once they can navigate these hurdles.
And I maintain my conviction that the current price accurately reflects the extraordinary risk of holding a company with chronic compliance failures and 9.3% gross margins. Until the governance risk is gone for good, and I mean multiple quarters of clean, timely filings, and that cash conversion cycle shrinks, the stock remains a classic value trap. That big revenue number is just masking awful shareholder economics.
So what we're left with is a textbook valuation paradox. You have strong, evidence-based arguments for two completely opposing outcomes: deep value on one side and value trap on the other.
Exactly. And ultimately, the stock's immediate future is going to be governed by these technical flows and short seller positioning, until that fundamental filing provides some real clarity. The entire decision really just hinges on whether you believe this regulatory mess is a temporary anomaly or a chronic, fundamental condition of the business itself.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.